Welcome to my podcast where I talk about all things related to money mindset, finance, business, and investing. My name is Royston Campbell-Batch, a qualified accountant with over 30 years experience in finance and business. Coming from a very humble background, I have continuously challenged the assumptions and the expectations of what I'm capable of achieving for myself and others. Over the years, I've helped hundreds of entrepreneurs to decipher finance and to make more money and to run highly successful businesses. On this podcast, I will share with you tips, strategies, techniques, and tools that you can use to make more money, manage money better, and to maximize your success. Welcome back to the podcast, and I got getting into the flow of this now. I think this is episode 10, so doing quite well. Some better news every time I do one of these podcasts in terms of the vaccine and getting back to the normal or new normal. I think I've been listening to the radio and flicked on the television this evening. And I don't normally watch TV, but I do watch when there's something exciting to watch, And they were talking about obviously a vaccine being approved in the UK. And over in Europe, they're a bit skeptical. It hasn't been approved by the Europe regulator, and I guess that's what they call Europe Brexit politics. You know what I mean? Not something I cover on this podcast, but just interesting, right? Because it kind of linked to this episode and what I want to cover today. Let me ask you the question: do you believe that taking risks is necessary to get ahead in business and life? And maybe ask you a second question: what significant risks have you taken to get ahead? You know what I mean? And if you look back, would you say that actually if you didn't take those risks, you wouldn't be where you are? Or maybe you took those risks and you didn't like where you are. You see, and that's the thing about a risk. Let me remind you what is a risk. It's an exposure to danger, an exposure to harm or loss. And for me, I like to see risk as being probability of an event occurring, and for me, everything is risky, literally. For waking up in the morning, you can fall off your bed. Okay, maybe you make it out of your bed, coming down the stairs. If you've got stairs in your house, you can fall down the stairs. Okay, maybe you make it to the kitchen, you can slip on the floor. Okay, maybe you didn't do that. You're left, you're going out in your car, bang, you can have an accident. There's always a probability of something can happen. Yeah, thing that is necessary personally, to take calculated risks. Yeah, based on your expertise, based on your skill set, based on your mindset, I think you can take risks and kind of estimate or calculate the probable outcome. That's why in this episode today, I want to talk to you about risk management from a kind of a investing or what is called a wealth creation perspective. Yeah. And before I get into the different types of risk and some of how you might want to manage the risks and all that kind of stuff from an investing perspective, let me talk to you a little bit about my story and how I had to take risk even to come to the UK to study. Because look, growing up was tough. I remember I tried to get my dad to help me in my early 20s. I went to Canada. He didn't help me. He turned me down. And I really knew I had it in me to do more, to be more, to help more people. Even though actually before I actually embarked on studying to become a qualified accountant, I had taught hundreds of adults, in business and accounting, I've also been a financial controller and all that back home in the Caribbean, back in Grenada. But I knew I had it in me to do more. I knew I could do much. I mean, when I was younger, I even wanted to do a PhD. Maybe something I can still probably pull off, but not my immediate focus right now. But look, I didn't have the money. I did not have the money to pursue my studies. I remember trying to go to the Navy, all that kind of stuff. I even got, applied for a scholarship and actually got approved to Cambridge College, but my grades weren't good enough. I guess it's a risk that I took, right? I got approved. The scholarship was approved, but Cambridge didn't accept me, right? But then I decided, okay, wow, I keep trying. I applied for a loan. Look, there was a risk that the bank didn't approve the loan. There's a risk that the bank turned it down, right? But I pushed. They even challenged me. Why do you want to go to the UK? Why don't you go to Trinidad and Tobago? I goes, no, man, I want to go to the UK, Mr. Saunders, who was my physics teacher, he told me that potentially the UK is good for me. But the polytechnics, I was always interested in a bit of science and a bit of business, And he said to me, yeah, go to the UK, go to the UK. That's the most I knew of the UK. I didn't know anyone apart from a friend. But look, the loan was approved, but my mom had to put up security, her house, her land, and even her salary went through the bank. That's a significant risk that my mom took. That's why I love her with all of me, and my whole desire is to make sure my mom is okay in any way possible where I can. But look, coming to the UK, right? Imagine coming to this place, man. I don't know no one here. I'm coming to study. My mom's salary is going through the bank. But you know what I had in me? I had the self-belief. I had the mindset. I took a calculated risk that once I had the opportunity, I can turn it into an expected outcome. And I think sometimes that's all people want. People want an opportunity, you see? And that's why sometimes, by borrowing money gives you the opportunity that you will not normally have, I think I focused on one of the podcasts on using debt to build wealth, It's a serious thing, right? Especially even if you look right now at how some of the big countries in the West, how they actually run. Even I was talking to some guys as well who I'm working with over in the Caribbean, and we're just discussing, and we was even saying even countries in the Caribbean as well, they're run on debt, you know what I mean? But some people, they have this false belief that, they wouldn't borrow to invest and all that kind of stuff. Look, sometimes it's necessary to borrow to invest, but what you have to do is take a calculated risk, and you must manage that risk very, very careful. So let me talk to you about some risk from an investment perspective today, yeah? I'm not going to go into these in great detail because I could be here a very long time. I myself have been a financial risk manager, so I understand a lot about the risks as well. But I just want to cover some stuff here as an introductory level. You know what I mean? I might come back with this in more detail in the future. From an investment perspective, there's various risks, yeah? And basically it's a risk of losing your money or losing a portion of your money. And it can be due to market conditions. We call it market risks. Yeah, I say, for example, the price of the market, if you invest in stocks and shares, that going against you. It can be a liquidity risk. For example, even in business, yeah, if you, for example, you cannot pay your suppliers, that's a liquidity risk because you cannot meet your financial obligations. If, for example, you're in business and you cannot pay back lenders, if you borrow money and you can't pay them back, it's a liquidity risk. Okay, you can say it's a cash flow risk, but cash flow is a bit more operational. Liquidity risk is a bit different. It's kind of related, but it's different, right? Then we have something called credit risk, yeah? And credit risk, again, is when a borrower, again, he failed to make payments, they're kind of related, but it's basically when you fail to make payments. So, for example, let me flip it away a different way. Now, when you put your money in the bank, yeah, as far as the bank is concerned, the bank owes you money. So if you have a lot of money, what you should be doing is spreading this. Don't put all your money in one bank. If that bank goes bust, they cannot pay you back, you see? And then you have a credit risk exposure. I remember one of my jobs as a financial risk manager, one of my activities was to look at the investment portfolio and make sure that no portion of the investment, or we don't invest any more than 10% in one particular institution. Obviously, these institutions are all giving us an interest rate, or they're giving us a return on investment. However, we have to spread the credit risk, yeah? Because normally, from an investment risk perspective, you must have policies. All these big companies that have what is called investment risk policies, market risk policies, liquidity risk policies. And you also have reinvesting risk, yeah? Because if you invest your money, say in a fund, there is two types of investment that you can have, right? Whether it's an income accumulation, or actually income units and accumulation units. I said income accumulation, but it's really one or the other. However, if you are accumulating or if you are reinvesting your interest or your dividend back into the investment, you can actually end up reinvesting at a lower price than which you entered into. It's a reinvestment risk. So basically, you are reinvesting at a lower ROI. And you also have other types of risks, operational risk, just the risk of like COVID, for example, operational risk, right? COVID, you cannot open your store. It's an operational risks, yeah. Then you also have project risks. You have currency risks as well. So, for example, I'm in the UK and I have a project. Say I have a project over in Grenada. Grenada use Eastern Caribbean dollars. I use pounds. So, for example, let's say it's a mortgage. If I have a mortgage there, I guess the monthly payment, if I try to service the mortgage from the UK, the monthly payment would not be the same because I'm exposed to currency risk, yeah? Because the Caribbean dollar is pegged to the US, but it kind of fixed to the US, but it fluctuates to the pound. So there's currency risks, yeah. But what happened, and this is how I know about the risk so much, because I worked in insurance for many years. And what it is that insurance companies, they can actually insure your business from all of these risks. They can underwrite all of these risks, by having an assessment of the risk and assessing the outcome. That's especially what an underwriter does, An underwriter looks at a piece of risk. Say, for example, there are different risks, aviation risk, for example. The risk of an aircraft falling out of the sky is also a risk that underwriters actually insure people for. But they can even insure the hull of a boat. For example, the risk of the boat catching fire inside the boat, I was so amazed when I worked in insurance, how many different types of risk an underwriter can insure, You can just, as I said, insure the ship, which is outside, and you can also insure the hull and that kind of stuff. So insurance is one way to protect yourself. And there is different ways. One from an investing perspective, one of the best ways to protect yourself is what they call diversification. As my grandmother would say, don't put all your eggs in one basket. Okay? So that's very much. So now we're getting into kind of the whole idea of risk on an investing perspective. And one thing I want to talk to you specifically about is something called the risk-return theory. I don't know if you ever heard this before, or the risk-return trade-off. And basically it states that the potential return rises with an increase in risk. Yeah, effectively, investing and risk return are highly correlated. What does that mean in layman terms? It means that as the potential risk of which you're investing in increases, so does your return. So that's why I actually use something called, I have a formula in my blueprint. I have a profitable business blueprint, and I have a formula in there called RATE, R-A-T-E. And when looking at the ROI, or return on investment, what I look at is something called the R is the risk. I always look at the risk, because the higher the risk, the higher the expected ROI. Yeah, return on investment. Obviously there are different kind of returns anyway. I wouldn't even go into that right now, right? But let's just say ROI, return on investment, or rate of rate of return, same thing. So next thing you have A, which is the amount, because clearly if you invest more and you're likely to get more. Obviously, it's a good investment, yeah? And time. The longer you keep your stuff in, especially in property investment, for example, because in every 10 years, apparently in the UK, property price has doubled, yeah, over the last 300 years. Every 10 years, property price has doubled, and I actually witnessed that my own self. Like kind of dabble in it a little bit, right? So all I'm trying to say to you here is that there is a risk-return theory. And the higher the risk, the higher the return. People who take a lot of risk tend to have a lot of money, you know what I mean? But at the same time, you have to take calculated risk. And there are various formulas, there's various tools and techniques that you can use to really look at what is called your risk-return trade-off, yeah? The next thing in my formula is obviously, I think I said time, and then E is just the expected return. So that's a formula for rate, yeah? So that is something that you really need to understand when you're looking to take risks, yeah? Because, according to the risk-return trade-off, yeah, invested money, can render higher profits only if the investor will accept higher possible losses. What does that mean? It means that when you are investing money, when you are looking to invest money, yeah, as Warren Buffett will say, yeah, you stand to win and you stand to lose. But if you really follow Warren Buffett, he said there are only 2 rules, yes? Number 1, don't lose money. And number 2, don't forget rule number 1. I'm saying all this to say that you can borrow money to invest, that's fine, but you must manage the risk. And when it comes to business, it's good to have multiple streams of income. What do I mean by this? I mean that don't just have one product or service. Yes, when you're borrowing that money to do that business, have multiple streams of income. So for example, even when I came to UK and I borrowed the money to do the accountancy stuff, I didn't just sit on my bum and just studied all day. No, I went out and I started getting jobs. I'm not like I was hustling, because I realized that I've got to pay the interest back home, number 1. But I realized that I've got to make money, you know what I mean? Always try to hustle, always try to do different things. Don't just rely on, if you're an employee, don't just depend on the job because they can make you redundant. If you have a business, don't just have one product or service, So spread your risk. By spreading your risks, you are minimizing your risk. By spreading your investment, you also spreading your risks, yeah? Because obviously the risk is the likelihood that something could go wrong, yeah? And there's different charts that you can use, of course, to measure your risk. We call them, risk bubble maps, etc. I'm not going to go into that. That's a bit more technical. If you're in business and you want to do assess your risk, you want to have a risk control framework, get in touch with me, roy@mmedu.co.uk, yeah, or roy@rapmax.com. Yeah, if you're in business and you want to manage your risk better, even if you want to know how to leverage money, how to borrow money to make money, get in contact with me. I think I'm the godfather of that. So leveraging debt to make debt is very risky. I told you my own story anyway. And it's something that if you're going to do, just make sure that you know what you're doing, yeah? So when you talk about leveraging, yeah, and I mentioned this a few times in different things that I've spoken about. What is leverage? But basically, all leverage is just using borrowed money to increase your return on investment, yes? So leveraging money is just basically borrowing money. One of the ways to leverage money, for example, is, let's say you're trading, you're a trader. You are just going to have some margin and you put on a small amount of margin and you can take a position. This investment can go, I don't know, they call it pips, you know what I mean? It can go 100 pips up, right? But potentially you put a stop loss in. If it falls by, say, 25 pips, then you close it out, yeah? So if it's $1 per pip, you're saying I can lose $25, but I can make $100 if it goes in my favor. You are leveraging, yes? Of course, there's a margin as well, but the margin obviously you don't really eat into the margin once you have stop losses, etc. Again, some technical stuff around trading. But I'm just trying to give you some examples here because one of the ways people make a lot of money is in Forex trading, is in trading the stock market. And that's how some people really make money from investing. But what they do is that they have stop losses. You see, it's about risk management. You have stop losses. You say, right, if this fall below this amount, you have a stop loss. And it's just the same in business. When I talk about insurance already, I talk about diversification. I think my last podcast was on financial controls and controls. So you want to have controls to manage the risks. But one thing that you do want to do, as I said, is to have your stop loss. Basically, you want to calculate the maximum amount that you are willing to lose and put in a stop loss there. And by the way, a stop loss also comes with insurance, yeah? So when if I recall my knowledge quickly, when you work in insurance, etc., and you manage risk, even the insurance company, they have to have a risk appetite, yeah? Or even if your business, you have to have a risk appetite, yeah? And what you will do, you will retain some risks and then you will insure the rest of risk. Let me break this down into a better example for you. So let's say, for example, you was insuring your business against loss of income. What you might do, you might say, okay, I will only insure my business against loss of income after 3 months. So you have a tolerance to say, if I don't make money in my business for 3 months, I should have enough cash flow to cover that. But if it goes after 3 months and I'm not making money, yeah, whether you're an employee, you can also have income protection as well. All these kind of income protection schemes, yeah. It's risk management. It's the managing the risk of not making money. That's what I'm talking about here, right? So effectively, you can then say for 3 months, I can deal with that. If it goes over 3 months, I want to insure myself against that. And then what you do is that you go and you take out a policy. So I'm saying here that sometimes you can take out a policy when it comes to investing. It's about taking calculated risks, and it's about understanding your exposure. One of the things, for example, that I did in financial services, again, is called asset liability management, because you also have the risk of mismatch. Assets and liability being mismatched, let's say in duration. Again, more technical, so I guess I'm getting very technical today. So one of the ways that we manage risks, or we manage risk in financial services, is we use something called asset liability management, ALM. Yeah, and here we make sure that the asset and the liability are on the same currencies and in the same duration. That mitigates a number of stuff, including things like liquidity risks. Yeah, I wouldn't go into too much detail. So I mean, look, I hope you kind of enjoy this. I mean, risk management is a very, very big topic. As I said to you, I'm not an expert in risk management. I have worked in risk management, mainly financial risk management, but there is a risk in everything you do. For example, let's take a project. There's a risk that the project doesn't finish on time. And if the project doesn't finish on time, maybe you'll be burning more money, you'll be using more money, and potentially you could even be sued as well. It's a number of stuff to consider in risks. That's why it's very important that when you're in business, you hire experts. You hire experts like me, financial experts, business management experts, to work in your business, to help you to control your risks, yeah? Because I think last time I was talking about Sarbanes-Oxley, I was talking about all this stuff. And the way it works from a financial perspective is always to assess the risk and understand what's your risk appetite, what risk you're willing to accept, and any risk that you're not willing to accept, you must either avoid it, remove it, reduce it, or potentially insure it. So I hope it all makes sense for you. Hope you can piece it together. And I said there's some good news coming as well. And look, this is episode 10, so I feel quite good. I'm on a roll now. I'm going to keep doing these podcasts. I'm getting to quite enjoy them. I think from next year, I'm still having some guests as well. I have a few people lined up already for that. So I don't know if you've been listening to all my episodes. I know there are a few people who've been listening to all my episodes. Big shout out to you. If you haven't listened to all the episodes, go back and listen to future episodes. Go and listen to past episodes and the future episodes. I'm getting carried away here. You can find me on Google. You just Google Royce and Cumberbatch and get to know more about me and what I do. I've got a number of projects and initiatives lined up for next year. So for me, it's all about staying strong, staying healthy, and keep doing what I'm doing. I want to wish you a very, very good evening or good day or good night, whatever time you're listening to this. Take care of yourself, take care of your family, and God bless. Bye-bye. Thank you very much for listening to my podcast. I hope you enjoyed the show. You can find out more about me by Googling my name, Royce Cumberbatch. I'm on all the social media, Facebook, Instagram, and LinkedIn. You can find me on YouTube as Roy Cumberbatch. And if you are listening on YouTube, please hit that subscribe button, or you can find me on my website at www.racmacs.com. That's RACMACS.com. It'd be great to hear from you, and do feel free to tell me about any topics you want me to cover on future episodes. Until next time, be good to yourself and others, keep positive, and reaching for your financial goals. Bye-bye.